I, Rohan Uttam Dumbre of MBA first year from section B. Our topic is inventory valuation policy of FMCG companies. I will be covering inventory valuation policy for Marico Limited, starting with a brief introduction about Marico Limited. Marico Limited is an Indian multinational consumer goods company providing consumer products and services in the areas of health, beauty, and wellness. Marico inventory valuation policy is in accordance with the Indian Accounting Standards IND AS2 inventories. IND AS2 inventories requires companies to value their inventory at the lower of cost and net realizable value and with weighted average method. What is NRV? NRV, it is a common method used to evaluate an asset value for inventory. Here are some of the benefits of using LCNRV by Marico. It ensures that the inventory is not overstated on the balance sheet, and the most important part is it protects the company's shareholders from losing. NRV can be negative also and positive also. If NRV is negative, it indicates that your product isn't valuable as the cost is incurred, and positive means your inventory will earn profit for you. If NRV is lower than cost, the company may not recover the cost of the inventory through its sales. So, the raw materials, finished goods, packing materials, stores, spares, work in process, and stock in trade are valued at lower of cost and net realizable value. Then they use weighted average method. What is weighted average method? In weighted average method, you give value to those factors which will have most impact while calculating the numbers. For Marico, the cost of raw materials and trade goods, which comprise of cost of purchase, cost of work in progress, and finished goods, which comprises of direct materials, direct labor, cost of inventories, and include all other costs incurred in bringing the inventories to their present location and condition. Cost is assigned on the basis of weighted average method. Thank you.
Imagine you run a company that sells various products and you need to keep a track of all of them. That is when inventory valuation comes into picture. Inventory is all the material that you hold to sell it in future. Emami, in the similar lines, Emami has used LCM method, which is nothing but lower to cost or market method. To understand this, let's take an example that you have purchased 100 units of material which cost 10 rupees. So you have acquired the material for 1,000 rupees. Over the period of time, you understood that the market value of per unit of material is 9 rupees. So LCM says that the inventory value of the material that you're holding today is 900. This way, you're cautious and not saying that your inventory is worth more. Now let's see what are the advantages and disadvantages of LCM method. Advantages: LCM is careful because it does not want to show that your inventory is worth more than what it actually is, and it is widely accepted. Let's see what are the disadvantages of LCM method. LCM can make your profit looks more because the market is volatile and it keeps on changing, and you have to adjust these numbers according to the balance sheet. At the end, if we say LCM is a smart way to keep a track of your inventory that you're holding. Thank you.
Hello everyone, my name is Rajveer Mihadia and today I am here to talk about the inventory valuation policy of Britannia Industries Limited. Britannia Industries Limited is an Indian multinational food and beverage company headquartered in Kolkata, West Bengal. It is one of the largest biscuit manufacturers in India. It values its inventories in certain heads such as raw materials and packing materials, work in progress, finished goods, goods in transit, and stores and spare parts. So, Britannia Industries Limited follows the lower of cost and net realizable value method to value its inventories. This means that the inventory is valued at lower of its cost and its estimated selling price less the cost of disposal. The cost of inventory includes the purchase price, any taxes and duties, and other costs incurred in bringing the inventory to its present location and condition. The net realizable value of its inventory is the estimated selling price in the ordinary course of business less the cost of disposal. For example, let's understand. Let's say Mr. X has an inventory of 100 chocolates. The purchase price of each chocolate is rupees 10 and the taxes and duties amount to rupees 1 per chocolate. The estimated selling price of each chocolate is rupees 12 and the cost of disposal are rupees 0.5 per chocolate. In this case, the cost of the inventory is rupees 11 per chocolate, rupees 10 as the cost price plus taxes and duties plus 0.5 as the disposable rate. The net realizable value of his inventory is rupees 11.5 per chocolate. Therefore, the inventory would be valued at rupees 11 per chocolate using the lower the cost net realizable value method. It is important to note that the inventory valuation policy is subject to change. Britannia rotates its stock regularly to prevent stock obsolescence. The company has its policy of selling the oldest stock first. This helps to ensure that the company does not lose money on stock that has become obsolete. This helps Britannia to ensure that its financial statements are accurate and true. Thank you.
Hello everyone, my name is Saili and I will be discussing ITC's valuation policy. ITC is one of the companies that we have identified for our assignment, and its valuation policy is in accordance with the Indian accounting standards, that is IND AS 2. According to this, inventories of ITC are stated at a lower of cost and net realizable value. So it is important that we understand what is NRV. Net realizable value or NRV is a valuation method which is commonly used in inventory accounting that accounts for the value of assets in terms of amount it would receive upon the sale minus selling cost. NRV is a conservative method used by accountants to ensure the value of an asset isn't overstated. So the policy of cost calculation which is used by ITC is based on the weighted average cost method. And the weighted average cost method, which is mainly utilized to assign the average cost of production to a given product, is most commonly employed when inventory items are so intertwined that it becomes difficult to assign a specific cost to an individual unit. This is frequently the case when inventory items in question are identical to one another. Also, the inventory cost method takes into consideration fluctuations in the cost of inventory, and it does by averaging the cost of inventory over the respective period. This helps businesses to mitigate the impact of the sharp price changes. Finally, weighted average cost provides a clearer position of the cost of goods sold, and it takes into account all the inventory units available for sale. This gives businesses a better representation of the cost of goods sold. So, to calculate the weighted average cost, we divide the total cost of goods purchased by the number of units that are available for sale. Thank you.
Good morning. I am Romil Patel, PRN number 230-2124-1125. Today I am going to explain about the inventory management of Dabur. But first let us understand what company is the Dabur. Dabur is a significant Indian consumer goods company which produces Ayurvedic medicines and natural products. As one of the largest fast-moving consumer goods companies, it generates about 60% of its revenue from consumer care, 11% from food, and rest of the revenue from international business. Dabur's inventory valuation policy is to assess inventories at the lower value between the cost and the net realizable value. Cost includes the purchase price and expenses to prepare inventory for the sale. Like shipping and taxes, net realizable value is the estimated selling price minus the selling costs. If an inventory item's net realizable value is less than its cost, Dabur adjusts its to prevent overestimating assets on the balance sheet. Aligned with Indian accounting standard 2, Dabur policies adheres to valuing inventories at the lower of cost or net realizable value. Factors influencing net realizable value assessments include the current market price, estimated selling and selling related costs, expected adjust price, competition level and economic conditions. Dabur regularly reviews this policy to ensure it complies with prevailing accounting standards and practices. In essence, Dabur is a major Indian company producing health and consumer goods. It values its inventory based on a smart rule that considers cost and potential earnings, aiming for accurate financing reports and transparency. Thank you.